Hi, I'm Jim Lowe. I'm one of the senior instructors at IFREC. And in this video, we're going to talk a little bit about capital gains and the calculation of capital gains at the sale of an investment property. Once again, it's important to keep in mind that this is not intended to turn you into a tax accountant, a CPA, or an enrolled agent. Always seek professional, trained advice about the details of how this is applicable to any customer or client. We're taking a look at the overview of generally how capital gains are arrived at in the sale of an investment property. So when you're taking a look at the slide, we're going to be looking at the calculation of those gains, and it starts with the sales price of the property, which makes a lot of sense. From that, the good news is that the seller does not have to pay taxes on the monies they expended to sell the property, commonly known as selling expenses. The selling expenses could be a variety of things. My favorite, broker commissions, attorney's fees, doc stamps, appraisal, engineering fees, anything that the seller expends as a necessary item to get the property sold will fall within this category generally. Once that's pulled out from the sales price, we're left with something described as the net sales price. The gain on the property is the differential between the net sales price and something called the adjusted basis of the property. As we mentioned in a previous video, one of the advantages of having investment property is the ability to shelter income by taking a depreciation or cost recovery deduction each year. That is what moves the original basis of the property down. So as far as the IRS is concerned, every year that you take that depreciation deduction, your property will be reduced in value by the amount of that depreciation. Conversely, if you add improvements to the property, that would increase the basis. Be careful here to note that improvements are not the same as repair. If you replaced a roof, that would generally be considered a repair. But if you added additional square footage to the building, that may be considered an improvement. Again, talk to your CPA to see how that actually applies. Once you've taken the deductions of all of the depreciation that's accumulated over the ownership period and added in any improvements, that is what's described as the adjusted basis. Again, the difference between that adjusted basis and the net sales price of the property is what is described as the gain. Another term you might see, as you can see here on the slide, is realized or realized gain. This is something you'd want to be a little careful about as you're looking at material, particularly in an exam question. Gain, realized gain, same thing for our purposes. That gain then has another opportunity for you to either delay or defer taxation. It's either a deferred or an excluded gain. Those come in two components, either from an installment sale, where the seller essentially is financing the property and not getting the full sales price in the year of sale, or something called a tax-deferred exchange. More commonly, you will hear people describe it as a 1031. Please tune into other videos to find out more detail about those two particular methods of deferring or excluding taxes on gain. If those are applicable, they're subtracted from the realized gain to leave you with something called the taxable capital gain. And this is the amount to which the tax rates are applied. Provided the property has been held for more than 1 year, it will qualify for a long-term capital gain tax treatment. This is called recognized gain. And currently, the maximum rate that you are usually going to see is 15%. However, because of a change in the tax code a couple of years ago, if you are over a certain level of income as a taxpayer, that tax rate for long-term capital gains can go up to as much as 20%. Any question or exam problem will specifically have to identify that circumstance if you're required to make that calculation. If not, you're comfortably able to rely on the 15% amount as the maximum capital gains tax. That's not the end of it, though. You will recall that the depreciation is a shelter against taxes in the years that the property's been owned. The IRS, upon sale, will recapture that at a rate of 25%. So all of the depreciation that has been taken for tax purposes is added up, multiplied by 25%. That's an additional tax that you will be paying as an investor upon the sale of the property. So adding together the long-term capital gain and the 25% recapture on depreciation gives you the taxes due at sale. Long, tedious process. Happily, you won't have a calculation that will require you to go through the entire thing, but you will certainly run into questions about parts of it. Take some time, review the video again, look at the formula. You'll do great. Thanks again for watching. We hope to see you again for IFREC and our videos.